Good afternoon, everyone, and welcome to our fourth and final webinar in this series. Or is it our final one? I'll come back to that in a moment. Today, we'll be focusing on the credit fund. My name is Ben Narcis, Director of Distribution at TAMIM Asset Management, and I'm joined by Darren Katz, the Portfolio Manager for the Credit Fund and co-founder of TAMIM. Our plan is to run today's webinar for approximately 35 minutes, leaving us 15 minutes at the end for Q&A. At the bottom of your screen, you'll find a space where you can raise questions during Darren's presentation. Darren will be happy to address them during the Q&A session. Also, please note that the webinar is being recorded and we will send out the recordings in the next few days. Disclaimer, as with all our webinars, we remind you that this presentation constitutes general advice only and is not tailored to your specific circumstances. As I mentioned earlier, the Credit Fund webinar was initially planned to be the last in our series, following the 3 equity-focused webinars we've run over the past few weeks. Normally, I would take this opportunity to provide a brief overview of TAMIM and our funds, but today I'd like to introduce an exciting new opportunity. 700 Sprigvale Road, Mulgrave, Melbourne. This property will join the 3 other assets currently held within our TAMIM property portfolio, with 1 property recently sold. After 3 years of dedicated searching by our property portfolio manager, Jeff Tate, we are thrilled to bring you this 6-level commercial office building, sitting on an approximate 9,000 square meter site in Melbourne, thriving Monash employment and innovation cluster. The property was constructed in 1991 and refurbished in 2015. The property is 88% leased to high-quality tenants, including Monash Health, CMP, Bunzl Australia, and Arthur J. Gallagher. The purchase price equates at around $3,600 per square meter, which represents a significant good buying compared to recent Melbourne office sales, and an initial passing yield of 7.58 and a fully let yield of 9.25%, and offering an IRR of 13%. One of the key opportunities we see in this property is the large land site, which offers potential for future development. This could provide significant long-term value, whether through redevelopment or other strategic uses as the area continues to grow and evolve. As you may know, TAMIM has a strong track record of acquiring properties in markets where others are hesitant to invest. We've been highly successful with this strategy, which enables us to acquire valuable assets at attractive prices. In the case of this property, we are seeing significant upside in the office space sector, with lower prices creating excellent opportunities for capital growth. This opportunity is truly rare, and I'm happy to share that 72 hours into our capital raising, we have already filled 75% of our capacity. If you'd like to be part of this property investment, I encourage you not to wait too long. For those interested, Jeff will host a special webinar tomorrow at 2:30 to dive deeper into this opportunity. If you'd like to register for the session or receive more information, please let us know in the box below and we'll follow up after today's webinar. With that, I'll hand things over to Darren. Darren, we're looking forward to hearing your insight today.
My name's Darren Katz. I'm the original co-founder and managing director at TAMIM Asset Management. I'm also the head of investments and the portfolio manager for the credit fund. Today's presentation is going to go through a number of different areas. First, we'll spend a bit of time talking around the current environment and what we're seeing happening out there and how that's going to impact on our portfolios. We'll talk a little bit about private debt and the rationale for private debt. In those segments, we'll spend a little bit of time focusing on maybe a bit of education, discussing how our credit managers actually go about assessing loans and what it is that they look at when picking loans to fund. And then we'll finally come back to the credit fund and talk about the structure, what's in there, how we go about putting it together, etc. So moving forward into the current macro environment, I'm not sure how many of you were originally on our March 2024 webinar, but it's a bit of an update on what we'd seen in that environment. So as at December 2024, we're currently settling into what we think is the aftermath of one of the most significant moves in interest rates in modern history, with the Reserve Bank of Australia increasing the cash rate from 10 basis points to 4.35%. Offshore moves were even more substantial than that, and particularly more rapid, specifically in the US and in Europe. And the impact of those rate increases was acutely felt in Australia due to the structure of our housing and mortgage market. So about a third of our population tend to be mortgage holders, and the transmission of rate increases in our part of the world is particularly swift. Unlike in the US, where fixed rate mortgages can be up to 30 years long, Australian borrowers typically fix their mortgages, when they do fix them, for a maximum of 5 years, with most people opting for about a 3-year term. Currently, the ABS reports that about 98.8% of all new home loans are being written on floating rates, which is slightly up from earlier in the year. This definitely reflects to us growing expectations around the population that we're at the peak of the interest rate cycle, or we're very close to it. For a floating rate mortgage holder who was paying 2% 2 years ago, their current rate now is somewhere north of 6%, which means that their repayments are approximately 3 times higher, putting significant pressure on them. While that third of the population has a mortgage, the other third of the population that we talk about tends to own their house outright, while the final third is in the renting category. The people that own their homes outright will benefit from the higher interest rates through increased returns on savings. Despite all of that, the 2/3 where people are renting and paying mortgages, you're finding that those consumers are under significant pressure. Retail sales in Australia have remained under pressure throughout 2024 as a result of that. And after adjusting for inflation, you've seen that they've been consistently negative for much of this period. The most recent data for November showed that retail sales growth was about 0.2%, which was a slight improvement from the negative 0.1% in the month before that. So 0.2 is still, in real terms, very weak. Discretionary spending remains the most impacted category that we can see as consumers adjust their budgets to manage higher mortgage repayments and living costs. And while everyday essentials have shown some nominal growth, this is predominantly attributed to ongoing price increases rather than an increase in volume. The Australian consumer, we think, remains under strain heading into 2025, with little relief expected until we either see the RBA move on an interest rate cut, or we see wage growth accelerating significantly. We are seeing some levels of wage growth in certain areas, but not across the board. While we've consistently been saying that we only expect the RBA to commence their cutting cycle in May next year, we've already seen the US, Canada, Europe, and our neighbours in New Zealand start their cutting cycles. So here's a fairly good question for you. And I know if I'd asked this to everybody a year ago, you all would have had the answer at fingertips. And I've actually done something a little bit different. I've created a poll on the webinar today. So if you all know how to hop on a poll, have a look at it, see if you can answer it. When is the next RBA meeting? And as I say, if I'd asked you last year, you all would have had the answer at your fingertips. The answer is actually they're currently in their meeting as we speak. And in fact, we should be getting an announcement out of them in about the next 20 minutes around what their thoughts are for the last meeting of the year. The belief from our perspective, nothing's going to be happening here, but let's wait and see. So if you look at the inflation landscape in Australia, this has evolved notably since March. And in March 24, earlier in the year, the CPI number was around about 3.6% on an annualized basis, which was a quarterly increase of about 1%. In October this year, the annual inflation rate had moderated quite a lot down to 2.1%, which is nicely in that RBA band, although this hasn't gotten them all that comfortable because underlying inflation, which is measured by the trimmed mean, increased to 3.5%, which was up about 30 bips from the September month end. So this shows us that there are still these persistent or niggling inflationary pressures sitting in certain sectors. The RBA acknowledged that there are mixed signals coming through and noted that the headline inflation, which is currently sitting within its 2 to 3% target range, is a good thing, but their worry was more around the underlying inflationary pressures. So our call earlier in the year around the US interest rate was proved to be pretty spot on. They have commenced their cutting cycle and they've been quite aggressive with 50 basis points and 25 basis points since then. What we really believed about the US, and we think this is very true in terms of the commentary we're seeing out of the marketplace, is that their interest rate bill of $1.3 trillion was just too high. In fact, the highest line item in their budget. And as a result of that, not so much their thoughts around the economy or inflation. They really had no choice but to reduce rates and just try and bring pressure on and bring that interest rate bill down. It's going to be really interesting to see what happens next year when Trump comes in post 20 January and puts his cost-cutting team of Musk and Ramaswamy to work during the course of the year. Within the credit fund, as a result of all of that, what we're thinking at the moment is that we're very interested in picking up fixed rate exposure across the portfolio, because we think that the movements are likely to be that rates start moving down. At an economic growth level in Australia, we've seen growth continue to decelerate since March. In the March quarter, the GDP numbers increased by a modest 0.1%, which resulted in an annual growth rate of 1.1%. By the September quarter, GDP growth remained subdued at 0.3%, which brought the annual growth rate down to 0.8%, which is actually the lowest we've seen since the COVID-19 affected December quarter in 2020. This is primarily due to weak consumer spending, as we've talked about a little bit earlier. Higher interest rates dampened consumer demand, which led to stagnation in household spending. This was partially offset by the government expenditure column. So government spending and public capital investment have been the primary drivers of GDP growth over the last 12 months, which indicate a reliance on public sector activity to sustain economic momentum. Our thoughts is that's generally not a good thing to see within an economy. There has been a decline, a historic decline in GDP per capita for 7 consecutive quarters now. Business lending in Australia has seen some growth, which has been a positive, particularly in the SME space, the small medium enterprise space, and construction sector. However, what we're starting to see is that risks are starting to emerge. We're seeing loan arrears starting to go up, and the economic headwinds are clearly starting to cause a challenge for some of these businesses. NAB recently reported an increase in the loans that it has on its watch list, particularly in the business and the private banking sectors. And the industries affected are construction, agribusiness, manufacturing, and food services. NAB's non-performing loans rose to about 1.4% in September, which is the highest since we saw in the September month of 2021. The bank does anticipate further increases in SME loan arrears in the coming months. So moving on from what we're seeing in the macro environment, we want to talk a little bit about private debt. And what is private debt? With rates being at zero or really low since 2008, and by that I mean the TAMIM investment team, really struggled with the idea of allocating to bonds to get our fixed income exposure. We knew that at some point we would see a situation like we did in 2022 till now, where interest rates increased dramatically, and that anyone holding a bond, being it a government bond or even a corporate bond, would face potential capital losses if they were selling those instruments. Remember, as rates go up in fixed income instruments, you see the price have the reverse effect and price goes down. So at that point in time, we actually took a step back from those types of markets, and we looked at private debt as a really interesting alternative, and we did really like what we'd seen in that space. So just something to point out before I move forward in the presentation is, and I think we'd said this again in March, is there's a lot of times where you'll see in the conversation the words either private debt or private credit. They tend to be used interchangeably, and so for the purposes of this presentation, we'll talk about private debt. Today in Australia, we think that private debt is considered to be a mainstream investment asset, and in fact, this webinar is not quite as popular as our Australian equity webinars this time around, but pretty close to it. And everybody that we come into contact with, from family offices to mums and dads, is interested in investing in private debt in some way. So what exactly is it? Effectively, private debt describes something, usually money, which is owed by one group or person to another group of people or person. Basically, it's a transaction where a lender provides a loan to a borrower. These loans are normally non-bank loans, which means that the lending party is generally not a bank. Importantly, that doesn't make the loans that we're entering into more risky. What we found that is that the banks have tended to remain outside of business lending over the last 5+ years, with much more focus on residential home loans. They tend to be more profitable for them, and their systems are set up so that they're much easier to operate. Private debt loans are just those loans that, because the banks are staying away from, we're finding that the private individuals or private groups are able to get out there and fund them at probably better rates for ourselves as investors, and something that makes a lot of sense to hold within the portfolio. So private debt tends to have a number of characteristics that make it interesting from our perspective, and obviously a strong candidate for investment or inclusion in investment portfolios. So those characteristics tend to be, firstly, that the loans are individual and unique. And as a result of that, they can be tailored to the benefit of the lender from a security of capital perspective. And security of capital is always very important to us. So this is done by the provision of collateral or security in the loan, or the provision of covenants or safeguards to the lender, or even both. Secondly, assets provided as security are generally hard assets. And in Australia, this collateral quite often tends to be property, sometimes business assets, or even business cash flows. And one of the managers that we invest into, which we'll talk a little bit about later in the presentation, is actually a specialist in business cash flow lending. So loans can also be structured to sit high in the capital stack. Quite often we'll find that they're senior secured. So that means that the lenders rank before other creditors in the event of a default. And finally, the loans will quite often be accompanied by personal guarantees from borrowers. The normal downside that we do see in private debt is that the loans tend to be illiquid in nature, which means that they'll be held for a longer period of time, and they're likely not to be easy to exit from prior to defined exit periods. There's a number of different types of loans, as you can see on the screen. This varies from unsecured, I suppose, to various kinds of property lending, and even lending, as I've mentioned earlier, against business cash flows. In the early days of private debt for us at TAMIM, we did run a number of closed-ended funds which focused on unsecured lending. And while all of these investment solutions were actually quite successful and profitable, we quickly learned that, bizarrely, you were able to get a better rate on loans where you had security versus the rates we were earning on loans which were unsecured. And we also figured out that in Australia, the level of protection given to lenders in an unsecured transaction was actually really poor. A lot of our due diligence on the underlying portfolios of these unsecured managers revealed to us that the credit work being done on borrowers was pretty substandard for those portfolios. And every now and again, we'd come across a borrower that was granted a loan when, if you had a look at their bank statement, you'd find deposits into gambling and betting accounts. For us, that's a red flag, and we certainly did not like what we're seeing there. The other thing that we noticed, which was quite relevant, was that on the recovery side of unsecured lending, because the loans tended to be quite a lot smaller than what you see in the secured part of the world, if a loan went bad, it was really too expensive to get in there and recover the loan through legal channels. So today we stay very far away from unsecured lending, and although the portfolio has an ability to put a small allocation to unsecured loans, it's not something that we do. With lending which is secured by property, we find that we're able to tailor strong security on the loans, and typically we do that at low loan-to-value ratios, close to about 60%. Also, there's a very good legal system which allows you to step in and take ownership of property security in the case of a default by borrowers. Interestingly, we also found some good loan portfolios which, as we've mentioned a couple of times now, focus on business cash flow lending. A really good example of this is in the manager that we'll talk about shortly in the presentation. We've historically lent funds to a recycling business which had a number of contracts with local councils for recycling. The banks wouldn't lend to these guys as the company was relatively new and it had only been operating for about 12 months. And even though the operators of the business had run it previously for a significant amount of time before that, the bank was not able to look through that requirement of a business having an operating history of greater than 12 months. The interesting thing with this particular business is that it actually had 5-year locked-in contracts from local government bodies. So no need to tell you the loans never missed a payment. They were paid on time at the end of the loan period. And the banks ended up missing out because their checklists or their crazy regulations wouldn't allow them to assess the real risks inside of this transaction. So now that we've given you a bit of a broad overview of private debt, why would you want to hold it in a portfolio? So to us, the first reason for investing is typically always attractive risk-adjusted returns. We're finding it possible to generate stronger returns. Excuse me, that's the symptoms of talking too much as a dry throat. So we're finding that it's quite possible in portfolios to generate stronger returns in private debt than we've seen in traditional lending products such as bonds. The returns are often in the form of stable and regular interest payments, which is always nice for us, especially when we're in retirement. Returns in some cases are even commensurate with equities, although that typically will come with a higher level of risk. Secondly, we like to earn returns that are different to the returns we're currently seeing from other investments we hold in our portfolios. And private debt brings that diversification. These investments, while they're not necessarily risk-free, the risk is there, but it's different, tend to act in a very different way to traditional asset classes such as equities or even property. That means that when you add them to your portfolio, they actually work to lower the overall risk in the portfolio due to the diversification benefit. You're also able to get exposure to different market sectors, geographies, which further increases the portfolio diversification. A third reason we see is the strong capital preservation qualities built into private debt transactions. This is tied back to our first point of risk-adjusted returns as very much and is very much the strong ability to secure the loan portfolios against collateral such as property, equipment, or receivables. Depending on the LVRs, the loan-to-value ratios of this collateral, that should help to protect capital in the case of a loan default. The inclusion of covenants, which we talked about in the last webinar, also provides extra layers of protections. The other reason is the protection against inflation, which has certainly been topical over the last 12, 18 months. In an environment where you have rising inflation, the ability to structure a portfolio in floating rate loans protects against inflation. So as the central bank increases cash rates, the yields delivered on floating rate loans increases. Even when you're holding private debt that is in the form of fixed rate loans, because you can actually hold them either as floating or fixed, depending on what you're investing into, what you'll find is that they tend to roll into new loans on average over about a 12-month period. So the new loans that you're entering into tend to reset at a higher level. And then finally, private debt will sometimes also present unique opportunities. Given that these loans are conducted in private markets and they tend to be less efficient than public markets, this will normally allow our managers or lenders to take advantage of risk mispricing. So onto a little bit of the educational side, and we won't spend too much time talking on this, but I thought it would be quite good to talk to you a little bit about the due diligence that our underlying investments or portfolio managers do in terms of looking at the loans that they are brought. So they typically will run origination teams, which will bring them loans to have a look at. And it's quite important to understand their due diligence and how they go about assessing these loans, whether they should be funding them or not. So the objective of a due diligence from their perspective is to evaluate the creditworthiness of a borrower, and that will ensure that the private lending deals are structured with minimal risk and optimal returns, hopefully. Due diligence in private lending is the investigative process used by lenders to assess the borrower's financial condition, their operational capability, the industry environment, and the creditworthiness of the borrower before they will be extended a loan. This typically will include reviewing all financial docs, legal docs, and the operational aspects of a borrower's business. The due diligence process typically focuses on 5 key areas or 5 critical categories. The first of this being financial due diligence, which is the analysis of the borrower's historical and projected financial performance. Next, we tend to look at business and operational factors in the due diligence process. So this is looking at their business model, their operational structure, what their positioning is in the industry, and assessing their strength there. Furthermore, we'll move towards the legal and regulatory side. And in this set of reviews, we try to ensure that the borrower complies with relevant laws and regulations. Always important that they're not breaking the law. From an asset perspective or collateral perspective, we want to sit down and look at the collateral that we're having as pledges, or that we're being able to have a pledge over. From a security perspective, we want to understand their quality, the value, and we want to know where the ownership of that lies. And then finally, the credit history and the reputation of the borrower. Clearly, we want to know that historically they've been financially reliable and they have a strong reputation. The tools and techniques that we would typically use in this process, or our managers would typically use in this process, there's 5 key areas there as well. First of which is financial modeling. So getting in there and having a look at their financials. We would go out, or managers would go out and create a multi-year forecast and try and understand what the business's ability to generate cash will be. And that will obviously tell you whether they can service the loans and repay the capital at the end of the period. You'll do discounted cash flows and scenario analysis around that. Benchmarking, we're typically going to compare the borrowers to their peers in the industry and understand if they're at the top end or bottom end of that scale. We'll always get out there and conduct site visits. It's really important to physically inspect the business, the location, and the assets that you're going to get as security. From a document verification perspective, it's always important, we think, not necessarily to take the borrower's word for what they're saying to you. So if they're giving you documentation, we'll typically have, or our managers will typically have, third-party auditors in there, or third-party legal advisors to check and see that documentation is valid. And then obviously background checks are always important. Some of the red flags that we've seen across time, weak financial statements, so negative cash flows and high debt levels typically are a red flag for us. That's it's always going to be a good indicator that someone's going to struggle to repay loans. If the collateral is questionable, I think to us that's probably one of the key areas. Overstated asset values or even disputed ownership is one of the spaces where you can get really hurt here. You need to be making sure that your valuations on assets, specifically property, tend to be very current. Certainly if you're in an environment where property values are declining, you want to make sure that you've got a really current and spot on valuation on those assets. Legal issues, so history of litigation, tax arrears or violations, and poor credit history are obviously key flags as well. And then finally, if you're seeing turnover within management or the business model tends to be weak, it's something that will turn us away from a loan. So this brings us now to the TAMIM Credit Fund. The portfolio was established in October 2018. Interestingly, and it doesn't feel like it's been 6 years and 3 months, but it's been running now for 6 years and 3 months. In that period, we've seen the first Trump presidency, we've seen a Biden presidency, we've seen some COVID, we've seen inflation, we've seen massive changes in interest rates. I don't know if you all remember it, but we saw a regional banking crisis in America. I'd actually forgotten about that the other day when someone asked me. And all the while, despite all of that, we've generated strong returns. We've only had one negative month through that entire period. And even that negative month was less than 0.5% down. We've paid quarterly distributions every quarter since inception, and we're currently seeing the 12-month outlook for the portfolio around about 8.5%. About 85 or just over 85% of the portfolio is in senior secured loans. The mezzanine loan component is pretty small at 2.4%, and then we're holding quite a high cash allocation at the moment of 12.2%. That will be allocated across the next quarter, so we expect that cash allocation to come down significantly. If you look at the portfolio that is actually invested into loans, about 81% of that is secured by property, and the remaining 19% secured against business cash flows. The TAMIM Credit Fund focuses on funding loan books for various funds or platforms in Australia. that source secured private loans and credit opportunities. In the current environment, we're thinking that our target on the portfolio is to beat the 3-year annualized RBA cash rate by around about 3.75% as an investment objective. In the credit space, for us, we think it's exceptionally important that you invest with experts. And as a result of that, we've put the credit portfolio together in a way where it is structured to invest or fund loan portfolios of experts in various segments of the private debt market. Overall, we have investments into 11 loan portfolios or credit opportunities, and 5 of those positions are what we would consider to be major positions. The other 6 that we're invested into currently are either single opportunities, which tend to be quite small, or managers in which we're holding small allocations as part of our due diligence process. And we'd said that in March to you earlier in the year. We tend to use time as part of our due diligence process. So assuming that managers pass due diligence, the position sizes definitely we'd expect them to grow. And over time, we would think that the portfolio, once it's in a significantly matured position, will hold no more than 10 major positions across the managers. We aim in the portfolio to diversify across geographies, lending types, underlying security, and industry types. And this will help us to deliver a consistent and stable set of monthly returns and quarterly distributions, which thankfully we've seen across the portfolio since inception. It's probably a good time now to talk a little bit about our due diligence or investment process. And I know we talked about what the credit managers themselves look at in their process. If you look on the slide here, I'm not going to talk directly to the 4 Ps as you see them on the screen: people, process, pedigree, and performance. I'm sure that when we send you the presentation a little bit later, you can read through all of those segments. But what I really wanted to focus on today is the 3 key areas that we always look at in our due diligence review. And those 3 areas are credit, legals, and experience, or what we like to call battle scars. Firstly, in this process, we look at prospective investments credit process, and this is from our perspective a key to what we look at, but it's really only the first building block of our review. If you can't assess credit quality specifically of your borrowers correctly, then you shouldn't be running a lending business in the first place. As I've said, though, it's only really our first level of due diligence. And more importantly, what we need to understand is the team and the lending business's legal ability and their legal documentation. We need to make sure that once a loan has been made to a borrower, if something goes wrong, and let's not kid, things always have a funny habit of going wrong, then in that situation, the lender needs to have a really strong legal ability to step on the underlying collateral and secure it to ensure there's no loss of capital. The collateral could be property, some other kind of real asset, or even contractual cash flows. At the end of the day, though, we need to satisfy ourselves that our lender's legal documentation is strong enough to protect them in the situation of a failure. Finally, it's really important that the lender's team and their experience, they have this ability to deal with tough situations. There's no point in having the best credit. There's no point in having the best legals in the world if your team just doesn't have the gumption or the capability to deal with a tough situation or a default situation. And let's not kid, not everyone's made to deal with that. Certainly, the credit managers that we look at are pretty tough individuals. So we always say that we want our managers to be highly experienced. We like it when they've been through bad experiences. And in fact, if they haven't seen bad debts or defaults on deals in the past, we typically don't actually want to invest with them. We like them to demonstrate what they've seen in these previous transactions to us. That we like it when they talk us through what they've learned and the actions they've taken in protecting their loans. So in short, what we want to see is their battle scars. And with all 3 of these things in place, so credit, legals, and battle scars, we generally will get comfort to proceed on an investment. On an ongoing basis, we definitely look across our portfolios to look we look to build deep relationships with the different loan platforms that we invest into, and importantly, we maintain a regular program of review on their operations. So let's take a look. We mentioned a bit earlier that we would talk about one of the managers in the portfolio. Last time round, it was a different portfolio or different manager that we talked about, but this time round, the manager that we're talking about is a group called Longreach. We've been invested with them for pretty much 6 years now. In fact, just over 6 years since the start of this portfolio. They've actually built an exceptionally strong business, and it's been pretty impressive to watch them grow through the years. They've got a diversified portfolio of private debt. They target returns of approximately 10% per annum, and it's mainly through business cash flow lending. So lending that's secured against the cash flows that come out of contracts that businesses own or operate. It's consistently delivered a strong performance. It's had low volatility. There have been no capital impairments across all the years that we've been invested with them. And the key benefits to our fund have included this level of diversification that has come through a very different style of lending. Their debt strategy invests across a range of sectors. It leverages a deep in-house credit analysis capability. They've got a really strong origination network and team, and this brings them unique credit deals that are not available to the broader market. So I know earlier we talked about battle scars, and this was one of the managers that we came across in the very early days that taught us this lesson. And the guys that operate the portfolio had come out of a significantly bigger lending business in one of the bigger investment banks in Australia. And interestingly, when we sat down with them, you could actually feel the tone in the meeting when they came in just got a whole lot colder. They were just really tough individuals that we felt were able to control and deal with a loan situation, and if something tough happened there, that they would have the ability to go through it. Capital preservation had always been central to their investment philosophy, and the good thing that we've seen there is no capital impairments since inception. They've had one enforcement action, and that seems to have worked really well in the portfolio. As of the last quarterly report, their portfolio has 24 loans, which obviously we're invested into. They've got a weighted average loan life of approximately 15 months. In recent quarters, they've increasingly focused more on the senior secured side. I suppose as the economy has weakened, you've seen them moving into a more secured side of the lending space. In Q3, the fund saw some significant activity, including a whole lot of loan repayments and obviously new commitments in some transactions. And interestingly, what they've also put in place is a new liquidity facility around the portfolio, which helps them reduce cash drag in loans getting repaid and then being redeployed. And one of the tougher things that we'd always found within the lending space was this whole concept of cash drag, especially when interest rates were low. Not so much of an issue today, but going back 4 or 5 years ago when cash rates were low, that cash drag of new money coming in and not being deployed was always a difficult thing. So they've pleasingly found a solution for that in the portfolio. So to come back to the credit fund and to give you a bit of a feel for what's sitting in there, the portfolio today numbers something like 450 plus loans across the book. We have, as we said earlier, 11 underlying investments, and 2 of those are currently smaller investments that we're doing due diligence on. We've been doing that for a period of time, but as I say, time for us has always been a factor in our due diligence process. Our last quarterly distribution was slightly lower than the previous one, coming in at 1.8%, but still strong. And around about 97.5% or just over 97.5% of the portfolio is either in senior secured loans or cash. As we said, our operation of the fund has been over 6 years, with our largest loan in the portfolio accounting for 3%. So because you're spread across so many different types of loans and your exposures across them are not that big, your capital preservation qualities in this portfolio are quite strong. The weighted average LVR in the portfolio is around about 64.5%, and the weighted average duration is around about 12 months across the portfolio. If you look at the fund from a return perspective, and you can see that pretty clearly on this table, the returns over time have been remarkably consistent and secure. You'd have to go back to 2019, I think it is, to see a negative month there. And we're currently, over the last 12 months, running at an 8.55% return. We think that we're pretty well placed to deliver similar types of returns over the next 12 months on the portfolio. The chart that you're currently looking at displays the distributions across the quarters, and again, remarkably consistent between 1.4 to 2.2%, and never missing quarterly distribution. So I'm kind of getting close to the back end of this presentation, and we might get to questions around the portfolio relatively soon as well. But before I do that, I've got a couple of items I just wanted to cover off. So just number one, key terms around the portfolio. So firstly, it's set up as an unlisted unit trust. The minimum investment amount on it is $100,000, and you are able to apply on a monthly basis. Redemptions on the portfolio are quarterly with 30 days notice, and the unit pricing on the portfolio is done on a monthly basis. Distributions are paid quarterly, and the management fee on the portfolio is 1.25%. We tend to say to investors that you should be looking at 3 to 5 years as your investment horizon. The portfolio has got a buy-sell spread of 0.2% on either side, and important to note, there is no exit fee on the portfolio as well. An admin and expense recovery fee of 0.15% is also payable. And also important to note, it's not on the screen here, there is no lockup on the portfolio as well. So just to cover off on the last set of items that I wanted to talk to you about, I think it's important to discuss why the TAMIM Credit Fund is deserving of your attention and why you should include this fund in your investment portfolio in comparison to other asset classes and possibly to other private debt alternatives that you're seeing out there as well. So firstly, we always say to investors, there's only really one reason to be investing, and that is to generate a return. Within this portfolio, we've consistently delivered on this front, and we're looking forward to being able to deliver around about an 8.5% return over the next 12 months. Secondly, we always say returns are good, but it's even better if you have investments in your portfolio which deliver these returns in very different ways. And the private debt portfolio does do this for you. It acts very differently to equities and property, and even maybe other fixed income that you likely already have in your portfolio. So that means by adding credit fund into your retirement portfolio, not only are you able to potentially improve returns, but you should be able to reduce your overall risk of the portfolio as well. Consistency of returns on the portfolio has been good, and the easiest way to demonstrate that is through the discussion around the number of negative months that it's had, which is obviously one. The credit fund has a focus on investing with top-tier lenders. So certainly in the private debt space, what we've seen over the last 12 months, because it's become so popular, is that there are a lot of new entrants into the marketplace, and we're really focused on making sure we're not going to untried and untested managers. We think that if there ends up being an issue in private debt, those untested managers will be the ones that will have a tougher time. Normally, these types of investments that we would put into the portfolio are tough to find, but even if investors are able to source them, in a lot of cases, they're not necessarily open to new investors. So the good thing about the credit fund is it's providing you access to these top-tier managers, and alongside that, it's providing you access into those without having to meet the minimums of those particular portfolios, because they tend to be quite high. At the TAMIM side, we run a professional investment management business, and as a result, we do a high level of due diligence and investigation before investing into any of the loan portfolios. And alongside that, we run an ongoing due diligence program. So every at least quarter, and sometimes on a monthly basis, we're running through due diligence meetings with our underlying managers. The credit fund is thankfully an open-ended investment. So a lot of times what you'll find with first mortgage type opportunities is that you're locked in for 6, 9, 12 months an opportunity. This one, you're not. You can come out at any time you choose to put in a redemption. On the portfolio, as we've mentioned, it's actually a unit trust investment as well. So you're not introducing an equity risk to private debt like you'd find across a lot of the LICs out there. So at that point, I think I'm actually going to stop talking. And I definitely thank you very much for taking time out of your day to listen to us. Hopefully we can continue to deliver strong returns for you going forward, or for new investors. We look forward to starting the journey. I might hand across to Ben to see if there's any questions.
Thank you, Darren. I will address a few questions that we've received. First of all, is the RBA. RBA came. I don't know if everybody was on their phones while you were talking, but they held. What are your thoughts on how we're going forward with that?
Well, there's a huge surprise for you. I think that the chances of a rate cut today were about a massive 0%. So yeah, that wasn't a shock. Next meeting, I think, is only February next year. The chances for us are that, and we've been saying this pretty much since the beginning of this year, we don't see the RBA moving on rates probably till May. There's possibly a risk that they hold longer than that, although we think that's probably going to be a policy error on their behalf. The economy to us looks pretty soft, certainly around amongst the consumer, and you know that 1/3 of the market where people hold mortgages or have home loans. They're doing it tough. Their payments going back a year ago now probably increased threefold, and yeah, we think a rate cut will be necessary to stimulate the economy at some level. So yeah, our view is around about May. From a credit portfolio perspective, with that in mind, and thinking that rates are going to be coming down, we definitely are looking for, as we mentioned earlier, more fixed rate exposure across the portfolio. And the nice thing is, the more fixed rate exposure we have there, the more we'll be able to just allow that to roll through, and that typically tends to take about 12 to 15 months to roll off our books.
Thanks, Darren. I got here another question. People think of recessions. Do you see a recession happening? And if that happens, will it negatively impact the fund?
So I'm not sure that we're going to see what is officially termed a recession, which is 2 quarters of negative GDP following each other. I'm not sure that necessarily will be what happens. But as we talked about earlier, you've had 7 quarters in a row, I think it is now, of reducing GDP growth. So it's probably one of the weakest periods we've seen in Australia from an economic growth perspective over a long period of time. So recession or no recession, I think we're in a weak environment. But the reality for us is we've seen this over our 6 years already. You've had COVID, you've had inflation, you've had interest rates, as we mentioned earlier. Things have been tough out there, and the one thing that we've seen is through tough environments, the managers that we invest into have been able to hold their portfolios really strong. They obviously do exceptional due diligence on the loans that they invest into. We've seen very few delinquencies. I think across the life of the portfolio, we've seen 2 loans which have gone bad. One of those loans we are still in the process of recovering fully, but we've got about 1 or 2% left to recover. And the other one, even though, as we'd said, it had gone bad, we recovered the loss on that as well. So even when things are tough, because you tend to have security on portfolios or underlying investments in your portfolio, you tend to recover them. I think the downside to that obviously is obviously timing. But as long as you're able to manage your timing on investments, that works pretty well.
Thanks, Darren. I got here another one. What role does diversification play in reducing risks for investors?
So I think we've covered off on that a fair bit in the conversation. But again, just to recap on that. So when you have an investment portfolio and you're generating returns out of different investments, the key is to find investments that generate those returns in very different ways. So putting a portfolio together which has equities, property, fixed income, etc., just allows you to bring in different types of return streams and diversification. So I think as we all get older and as we all move towards retirement, trying to take volatility out of the portfolio is not necessarily possible, but reducing volatility certainly allows for that journey, that investment journey, to be a lot more fun and smoother. Certainly, no one enjoys sitting in a portfolio when it's down 40% in a month, but certainly allowing yourself to spread your investments across different assets tends to help prevent that.
All right, let's try another one. I know it's come late. How does the fund handle potential credit downgrades or distressed assets?
Yeah, and again, I think we've probably talked to that a little bit as well. The key with this portfolio is that most of what we're investing into is secured against hard assets. So if you see a downgrade or a default or something going wrong in a loan, in most instances, I think the stat was 81% of the portfolio secured against property and the other 19% against business cash flows. But when you're secured against real assets or even a cash flow type asset, and something goes wrong, you can step in and take on that asset and allow yourself to recover the loan. And specifically in the case of this portfolio, when your loan to value ratios are low, you're sitting at around about 60 or 64% on your loan to value ratios. You're typically going to be able to recover all of your capital. And in certain instances, actually, the terms of the deal will allow you to actually earn significantly higher rate of interest in a case where a loan defaults. So I think from a risk perspective, your risk is not necessarily that. It's going to be around maintaining your liquidity on a portfolio and making sure that you're not forced to sell out of assets at the wrong kind of time frame.
I was going to stop there, but I see here another question. Do members of the fund manager team have personal investments in the fund?
Yeah. Thanks for asking, Ben. Look, we run an investment business. It's pretty large. It's something like, well, sorry, in the context of the investment world, maybe we're a boutique, but we manage somewhere north of $240 million for our clients. And really, the view internally in the firm is that it would not make any sense for us if we were asking people to invest into investments and products that we were not invested in ourselves. So between myself and the management of the business, we're all significantly invested across all of our products. Certainly, the credit fund for me is one of my biggest investments that I would hold. So yeah, we're all significant investors across not only this, but all of the TAMIM products as well.
Thank you, Darren. I appreciate it, and thank you for your insightful presentation. I know we've all gained valuable insights for your talk. For those, application forms and information can be found on our website, www.tamim.com.au/credit, or you can contact us on 1300 750 007. Thank you all for joining today's session. As we approach the end of the year, I want to take a moment to wish you and your loved ones a joyful holiday season and a prosperous new year. We appreciate your continued trust and partnership, and we look forward to working together in the new year ahead. Stay safe and take care. Thank you.